All right. Hello, neighbors, and good morning. Welcome back to the neighborhood, or welcome if this is your very first time. You are very welcome here. I am Squealer D, and I am back again. And this time we are back in the beautiful world of finance to learn about financial statements. We are continuing with the whole stock market theme, and this is day 4. It's really like day 12, but I keep recording without the mic on, guys. Yesterday I did an hour and like 12 minutes of live, and I did not have my mic on, so nobody could hear me. Josh Locke, hello, neighbor. How are you, my friend? It is great to see you in the chat. I thought that I was going to be here alone doing this in the morning, but it is great to see you drop by. Today, I am going to be breaking down financial statements for myself. I went through it a little bit yesterday, like I said in my live that didn't get recorded, but that's okay. Everything is so difficult that it's okay to go over it twice. So we have this article we're going to go through is from the U.S. Securities and Exchange Commission. Guys, we learned that is the SEC, and they are the regulatory enforcement group of the stock market, and we learned that on the first day. So we have things to learn. Let me see. Let me just make sure all of my chat boxes are up so I can see the chat. And we are going to get into this. So this is a great place in their investor information. It comes with reports and publications for investors, alerts and bulletins, tools and calculators, education resources, and contact information. So this is a great website to learn from. And even if they don't tell you exactly, they will give you the path that you will need to take. So let's jump into this. I have some things here to help us understand these. Since we are learning about financial statements, guys, that includes the balance sheet, the income statement, the cash flow statement, and stockholders' equity. So we will be looking at each one of those. So we're going to read through this, and then we're going to break it down with Investopedia. So the two sources we are using today to learn are the sec.gov, and that's an official site, and one of my favorites, Investopedia. It's like Wikipedia, but for investors, guys. It is really cool. So let's learn the basics. If you can read a nutrition label or a baseball box score, you can learn to read basic financial statements. And the reason that we need to learn these, guys, are because if you can read a business's financial statements, you can learn if the business is a good investment or a bad investment. And you need to be able to do that if you are not going to get a robo advisor or an actual advisor. Morning coffee, guys. D is for dinero. Let's get it. So like I said yesterday, I did all of this, guys, and I had no microphone. So let me see. Look at the bars, check the bars, make sure we're recording, and let's get reading. If you can follow a recipe or apply for a loan, you can learn basic accounting. The basics aren't difficult, and they aren't rocket science. This brochure is designed to help you gain a basic understanding of how to read financial statements, just as a CPR class teaches you how to perform the basics of cardiac pulmonary resuscitation. This brochure will help you explain how to read the basic parts of a financial statement. It will not train you to be an accountant, just as a CPR course will not make you a cardiac doctor. But it should give you the confidence to be able to look at a set of financial statements and make sense of them. And that is what we want, my friends. So let's begin to look at what financial statements do. Show me the money! We all remember Cuba Gooding Jr.'s immortal line from the movie Jerry Maguire. Show me the money! If you don't remember it, go watch Jerry Maguire, guys. That was 90s gold, right? Well, that's what financial statements do. They show you the money. They show you where a company's money came from, where it went to, and where it is now. There are four main financial statements. They are the balance sheets, income statements, cash flow statements, and statements of shareholders' equity. And let me just, statements, I'm going to make sure. Okie dokie. Sorry, guys, had to check the volume after yesterday. So yesterday wasn't the very first time that I've streamed live with no volume, guys. Yeah. I've done this like 4 times. I've had live streams and I stream for like an hour and a half and I never turn my mic on. So if you come in and I am streaming live and you don't hear me, throw it in the chat for me. Say, Squealer D, turn on your microphone. Okay, but we are good, guys. So there are 4 of them: balance sheets, income statements, cash flow statements, and statements of shareholders' equity. And I have them up here from Investopedia. We're going to go through them afterwards. Balance sheets show what a company owes and what it owes at a fixed point in time. Income statements show how much money a company made and spent over a period of time. Cash flow statements show the exchange of money between a company and the outside world, also over a period of time. The 4th financial statement, called a statement of shareholders' equity, shows changes in the interests of the company's shareholders over time. Let's look at each of these first 3 financial statements in more detail. A balance sheet provides detailed information about a company's assets. We know what those are, guys. Those are things, that make the company has that make money, right? Liabilities are things like bills that you owe, and shareholders' equity, which are these 2 together. This minus this gives you this. So, okie dokie. Assets are things that a company owns. Money, guys, owns and have value. This typically means they can either be sold or used by a company to make products or provide services that can be sold. Assets include physical property, such as plants, trucks, equipment, and inventory. It also includes things that can't be touched, but nevertheless exist and have value, such as trademarks and patents, and cash itself is an asset. So are investments a company makes. Liabilities are amounts of money that a company owes to others. This can include all kinds of obligations, like money borrowed from a bank to launch a new product, rent for use of a building, money owed to suppliers for materials, payroll a company owes to its employees, environmental cleanup costs, or taxes owed to the government. Liabilities also include obligations to provide goods or services to customers in the future. So shareholders' equity is sometimes called capital or net worth. It's the money that would be left if a company sold all of its assets, so everything that they have that's value. So if they sold all of that and paid off all of its liabilities, everything it owns, what's left is the shareholders' equity. This leftover money belongs to the shareholders or the owners of the company. So the following formula summarizes what a balance sheet shows. Assets are equal to liabilities plus shareholders' equity. A company's assets have to equal or balance the sum of its liabilities and shareholders' equity. So if it doesn't, guys, let's say that this is you. Let's easily understand it. Assets equal liabilities plus shareholders' equity. So everything you own, this is everything you own, this is everything you owe, and this is what's left over. So if, let's say, everything you own is $10, but you owe the guy who mows your lawn $5, what is the shareholders' equity? $5, guys. It's that simple. 5 plus 5 equals 10. So 10 minus 5 equals 5. It's easy. Simple, guys, and we're going to go over it a bunch of times. So even if you don't know lick of math, we can do this. It's okay. We are going to be able to, at the end of this, look at a balance sheet, look at an income statement, look at a cash flow statement, and make a decision on whether or not you should be involved in trading that stock or anything to do with that stock. or that company. You should be able to look at a company and see if that company is, if they make money, if they lose money, if they're lying to their customers. If a company is lying to their customers, they're going to be lying to their shareholders, because that's what you are. So we have to be able to look at companies and understand it so that we can do this for ourselves, or get a robo-advisor. Guys, I don't have enough money to get a robo-advisor because I am starting at the very, very bitty bottom. If you can afford an advisor, I suggest you get an advisor and learn. I would do both. But that's me. So there we go, guys. A company's balance sheet is set up like the basic accounting equation shown above. On the left side of the balance sheet, a company's list their assets, everything they own. So if you listed everything you own. On the right side, they list their liabilities. So this would be everything you owe, like your taxes and your water bill and your light bill and your rent. And this is everything that's left over. Okay. So on the right side, they list their liabilities, and sometimes balance sheets show assets at the top, followed by liabilities and shareholders' equity at the bottom. So this is, we are going to go to, I want to make sure that we are going to look at each of these ones. We looked at a balance sheet. So let's look at this. This is what we are learning right now. Assets are cash, inventory, or property. And that is equal, all of this is equal to everything you owe plus everything that you have left, shareholders' equity. And that makes sense, guys. What do you have in your pocket? Well, if you had $100 in your pocket, right now, you have $100 cash. That seems like an asset, right? But you know that you don't just have $100, because maybe you're going to go pay a bill at work. You owe $20 to, I don't know, the lunch lady at work. So your assets are equal to your liabilities and shareholders' equity. So your assets would be that $100, right? But your liability would be that $20 that you owe the lunch lady, plus your shareholders' equity. So what would this be, guys? If we had 100 and we owed 20, what would this be? $80. Simple, guys. Simple ways to look at things quickly. I mean, even if you can't do that in your head, you can do it on a calculator really quickly. So if we were looking at your pocket with that $100 and you owe $20 to the lunch lady and everything is left for shareholders, $80, that is a pretty good, what is that? 20 out of 80 is 1/4. That's a fourth, 25%. That's pretty good. That's pretty good. Retained earnings would be 75%. That would look like a good company. You look like a good company with $100 in your pocket and only $20 worth of liabilities. And that's just one of the sheets, guys. We are going to have other sheets we look at. So these are things you will look at when judging a company. And it's also things you should look at when you go work for a company. To be honest, guys, we shouldn't be working for companies that aren't working for themselves. If the company doesn't have a good balance sheet and a good income statement, a good cash flow statement, good stockholders equity, the business probably isn't doing too good. Just in my opinion, guys. So I might be wrong. I mean, show me a business that's doing really good, but their balance sheet, income statement, cash flow statement, and stockholders equity all say that they're not. I don't think it happens, guys. So prove me wrong, though. I love to be proved wrong. It makes me laugh. So we saw that, how it looks, right, guys? So assets are generally listed based on how quickly they will be converted into cash. Current assets are things a company expects to convert to cash within 1 year. So like your paycheck, guys. If you are a business, your paycheck would be a current asset. A non-current asset are things a company does not expect to convert to cash within 1 year or take longer than 1 year to sell. So your inventory is current asset. You're going to sell that, right? You don't want to keep your inventory forever. Non-current assets are things that take longer. And non-current assets include fixed assets. Fixed assets are things that are used to operate the business but are not for sale. So let's say your business is you mow lawns. If you mow lawns, everything that you can convert to cash within 1 year is a current asset. So anytime somebody pays you and you can go cash that check, that's a current asset. A non-current asset or a fixed asset, these non-current assets include fixed assets. There's two, non-fixed and fixed. Fixed assets are things that you use to operate the business, like your truck and your lawnmower. I don't know. What else do you guys use? Edgers? I don't know. Whatever you use. Those are fixed. I shouldn't use examples that I don't really know a lot about. Construction, I could have did. Lawn mowing, I mean, the only thing I've ever used is a weed eater and a lawnmower. So, I mean, I guess you guys could have like shrub, I can't even say them. Shrub. What do they call those things that cut the shrubs? I don't know, like a shears? Okay, we're not learning about that today, guys. We're learning about liabilities are generally listed based on their due dates. So those are bills, guys. Think of it like bills. Liabilities are said to be either current or long-term. Current liabilities are obligations a company expects to pay off within the year. Long-term liabilities are obligations due more than 1 year away. Makes sense, right? Long-term, long time away. Current, guys. These are basic terms we can learn. And we're going to go over them and over them and over them and bang them into your head. Bang them into my head. That's how I learn, guys. By reading this, talking about it, that's how I learn. I got to make sure I drink my coffee before it gets cold. I do not like cold, hot coffee. I'll take coffee with ice, but I don't want cold, hot coffee. Okay, shareholders' equity is the amount owners invested in the company's stock plus or minus the company's earnings or losses since inception when it was made. Sometimes companies distribute earnings instead of retaining them. These distributions are called dividends, and we learned about dividends, guys. They pay them. We can go into Investopedia and say, what are dividends? And we can refresh ourselves. And we could go right in here. Look, dividends, Investopedia. Dividends are the distribution of corporate profits to qualified shareholders as determined by the company's board of directors. Remember how we said, guys, a dividend is not owning the company. If you get dividend money, it is outside of the share money. So the share might be $5. It doesn't mean your share went to $6. It means you got a dividend, which is different money. So we know what dividends are, guys. See, we're learning these words, and we come back and we see them and we knew them, and it's great. So a balance sheet shows a snapshot of a company's assets, liabilities, and shareholders' equity at the end of the reporting period. So a balance sheet is just everything we just talked about, but in one. It does not show the flows into and out of the accounts during the period. So this is like if you wanted to go get a bank readout of your bank and it had every single in and out, in and out, in and out, in and out with dates, that would be more like a probably a liabilities or an assets balance sheet with it has ins and outs of money. And then if you just got the basic, like, show what you have, that's a balance sheet. So income statements is a report that shows how much revenue, and we know the balance sheet is, I'm going to show you guys, it looks like this. Assets equals liabilities and shareholders. We got that. So an income statement is a report that shows how much revenue a company earned over a specific time period, usually for a year or some portion of the year. Like they do quarters. So quarterly is every 4 months. An income statement also shows the costs and expenses associated with earning that revenue. The literal bottom line of the statement usually shows the company's net earnings or losses. This tells you how much the company earned or lost over the period. So here's an example. We have the revenue that they made from merchandise sale, revenue from training, total revenue. Then they have their expenses, costs, wages, rent, interest paid, transportation, utilities. Man, where did they get their utilities? Oh, it was just for the quarter. Dang. 4 months of utilities for $150? Good job. So then gains, they sold a van. Losses, and they had a lawsuit. And then net income was the bottom line. Revenue plus gains minus expenses and losses. And that makes sense, guys. When you get your check, you have what you earned minus what you spent is what's left over for your bank account, right? So that makes a lot of sense. Income statements show the bottom line of what you got. So income statements also report earnings per share. This calculation tells you how much money shareholders would receive if the company decided to distribute all the net earnings for the period. Companies almost never distribute all of the earnings. Usually they reinvest them in the business. To understand how income statements are set up, think of them as a set of stairs. You start at the top with the total amount of sales made during the accounting period. Then you go down one step at a time. At each step, you make a deduction for certain costs or other operating expenses associated with earning the revenue. At the bottom of the stairs, after deducting all of the expenses, you learn how much money the company actually earned or lost during the accounting period. People often call this the bottom line. At the top of the income statement is the total amount of money brought in from sales or products of services. This top line is often referred as gross revenues or sales. Okay, so revenue or gross revenue or sales, and that's what they put there, right? Total revenue, merchandise from sales, and training. Okay? The top line, it's called gross because expenses have not been deducted from it yet. So the number is gross or unrefined. The next line is money. The company doesn't expect to collect on certain sales. This could be due, for example, to sales, discounts, or merchandise returns. When you subtract the returns and allowances from the gross revenues, you arrive at the company's net revenues. It's called net because if you can imagine a net, these revenues are left in the net after the deductions for returns and allowances have come out. Okay, so back to this income statement. And here's your revenue, guys. This is gross. Because it's gross, it's unrefined. Then once you take out the wages, you catch them in the net, and this becomes net. We're getting it, guys. This is gross. Gross because it's unrefined. It doesn't have everything taken out of it. Then you use the net, and you capture it. Got it, guys. This is clicking. Moving down the stairs from the net revenue line, there are several lines that represent various kinds of operating expenses. Although these lines can be reported in various orders, the next line after net revenues typically shows the cost of sales. This number tells you the amount of money the company spent to produce the goods or services is sold during the accounting period. So let's see if we have one. Well, this is what they sold, and this is, they had a lawsuit. So there's a little different in a little different order, and that's okay. So the next line subtracts the cost of sales from the net revenues to arrive at the subtotal called gross profit, or sometimes gross margin. It's considered gross because there are certain expenses that have not been deducted from it yet. So if it's not refined, guys, think of something hasn't been deducted, it's not refined, it's gross. Ugh. They haven't finished it yet. Ugh. Okay, so the next session deals with operating expenses. These are expenses that go towards supporting a company's operations for a given period. For example, salaries of administrative personnel, costs of researching new products, marketing expenses are another example. Operating expenses, these people had a settlement cost. So that would be that. Marketing expenses are another example. Operating expenses are different from costs of sales, which were deducted above because operating expenses cannot be linked directly to the production of the products. So marketing doesn't make the products. It doesn't get the product shipped out. It doesn't get the product sold. Well, it gets the product sold. It is what sells. Marketing gets your product sold, but it's not part of the product. So it's operating expense. Okay, depreciation is also deducted from gross profit. Depreciation takes into account the wear and tear on some assets, such as machinery, tools, and furniture, which are used over the long term. So if you're like a tech company, you have a lot of computers, you might have to upgrade your computer if, let's say, you do editing and you need a stronger graphics card. That would be depreciation, right, guys? Your old graphic card depreciated. You need a new one. So companies spread the cost of these assets over the periods they are used. This process of spreading these costs is called depreciation or amortization. The charge for using these assets during the period is a fraction of the original cost of the assets. So After all operating expenses are deducted from gross profit, you arrive at operating profit before interest and income tax expenses. This is often called income from operations. Next, companies must account for interest income and interest expense. Interest income is the money companies make from keeping their cash in interest-bearing savings account, money market funds, and the like. On the other hand, interest expense is the money companies paid in interest for the money they borrow. Some income statements show interest income and interest expense separately. Some statements combine the two numbers. The interest income and expense are then added or subtracted from the operating profits to arrive at operating profit before income tax. Finally, income tax is deducted and you arrive at the bottom line, net profit or net losses. Net profit is also called net income or net earnings because that is what is made. This tells you how much the company actually earned or lost during the accounting period. Did the company make a profit or did it lose money? So, earnings per share or EPS. Most income statements include a calculation of earnings per share or EPS. Let's see if ours has EPS, guys. Ours doesn't have EPS. That's okay. Some of them won't. This calculation tells you how much money shareholders would receive for each share of stock they own if the company distributed all of its net income for the period. To calculate EPS, you take the total net income and divide it by the number of outstanding shares. Okay, so what's their net income? We could figure this out if we knew net income is $21,350. So if let's say they had shares, let's say they have, I don't know, how many shares do people normally have? If they had 1,000 shares, I'm sure they would have more than that, guys. But all you do is take the total net income and divide it by the number of shares. So you would take this number, 21,350, and divide it by the shares. So if it was a little number like 1,000, your shares would be worth a lot. Your EPS would be high. But if the number was 1,000,000 shares, it would be very low. It would be like 21 cents. So, cash flow statements, guys. And we got these right here. We're going to learn about cash flow statements. Cash flow statements report a company's inflows and outflows of cash. This is important because a company needs to have enough cash on hand to pay its expenses and purchase assets. While an income statement can tell you whether a company made a profit, a cash flow statement can tell you whether the company generated cash. Okay, so a cash flow statement shows changes over time rather than absolute dollar amounts at a point of time. It uses and reorders the information from a company's balance sheet and income statement. The bottom line of the cash flow statement shows the net increase or decrease in cash for the period. Generally, cash flow statements are divided into three main parts. Each part reviews the cash flow from one of three types of activities: operating activities, investing activities, and financing activities. Okay, so cash flow, net earnings were $2 million. So here's the additions. They had some depreciation, decrease in accounts, increase in taxes payable. They had an increase in inventory of $30,000. So that took from the cash. So they had all these cash. They had this much earnings. Net cash, okay, so they have $2,012,000. Equipment and notes payable, and the cash flow was 1.5. The bulk of the positive cash flow stems from cash earned from operations, which is a good sign for investors. It means that core operations are generating business and that there is enough money to buy new inventory, which they did. They bought equipment, right, guys? And increase in inventory. So the purchasing of new equipment shows the company has the cash to invest in itself. So these are things you're looking for when we are deciding if we want to invest in a company, guys. They have enough money to buy new inventory. They have enough money to invest in itself. Finally, the amount of cash available to the company should ease investors' mind regarding the notes payable, as cash is plentiful to cover that future loan expense. And we're going to go into these ones and learn more about them, guys, but today is just the overview to give you the words. Once you hear the words one time, the second time you hear them, it becomes a little easier to understand, I found, at least for me. And if it doesn't for you, well, then heck, skip this one and watch the next one. So, cash flow statement. We have cash flow statement right there. Okay. Cash flow statements report a company's inflows and outflows of cash. This is important because a company needs to have enough cash on hand to pay its expenses and purchase assets. While an income statement can tell you whether a company made a profit, a cash flow statement can tell you whether the company generated cash. A cash flow statement shows changes over time rather than absolute dollar amounts at a point in time. It uses and reorders the information from a company's balance sheet and income statement. Okay, so it uses both of these to make this. Got it. The bottom line of the cash flow statement shows the net increase or decrease in cash for the period. Generally, cash flow statements are divided into 3 main parts. Okay, so we got that, guys. The first part of a cash flow statement analyzes a company's cash flow from net income or losses. For most companies, this section of the cash flow statement reconciles the net income, as shown on the income statement, to the actual cash the company received from or used in its operating activities. To do this, it adjusts net income for any non-cash items, such as adding back depreciation expenses, and adjusts for any cash that was used or provided by other operating assets and liabilities. And we can see that they did that, guys. They put their depreciations in here, decrease in accounts receivable, increase in accounts payable, increase in taxes payable, and these were probably like refunds, things like that, things that the company did. I don't even know what company this is, but it doesn't really matter. Okay, so the second part of a cash flow statement shows the cash flow from all investing activities. So, from invested in equipment, see that? Which generally include purchases or sales of long-term assets, such as property, plant, and equipment, which they had machinery, right? As well as investment securities. If a company buys a piece of machinery, the cash flow statement would reflect this activity as a cash outflow from investing activities because it used cash. If the company decided to sell off some investments from an investment portfolio, the proceeds from the sales would show up as cash inflow from investing activities because it provided cash. So, addition to cash, subtractions from cash. Net cash from operations, cash flow from investing, cash flow from financing. Okie dokie. Break it down real easy for us. Okie dokie. This is so much, guys. The third part of cash flow statement, and like I said, this is basic accounting. This is not even just the stock market, guys. This is like things that a basic accountant would know, and that some people hire lawyers and accountants to look at for them when they make these decisions. We are learning to do it all by ourselves. We are going to be a one-man show. Okay. Let's see. The third part of the cash flow statement shows the cash flow from all financing activities. Typical sources of cash flow include cash raised by selling stocks and bonds or borrowing from banks. Likewise, paying back a bank loan would show up as a use of cash flow. A horse called Read the Footnotes ran in the 2004 Kentucky Derby. He finished 7th, but if he had won, it would have been a victory for financial literacy proponents everywhere. It's so important to read the footnotes. The footnotes to financial statements are packed with information. Here are some of the highlights. So, they have significant accounting policies and practices. Companies are required to disclose the accounting policies that are most important to the portrayal of the company's financial condition and results. These often require management's most difficult, subjective, or complex judgments. Income taxes. The footnotes provide detailed information about the company's current and deferred income taxes. The information is broken down by level, federal, state, local, and foreign, and the main items that affect the company's effective tax rate are described. So these are things that are in the footnotes, guys. Significant accounting policies, income taxes, pension plans, and stock options. They show you in the footnotes more than our own President of the United States, Donald Trump, would show. He refused to show his income taxes. For years, they had to force him. But a company is Has to do it just so you can see if you can invest in them. So we didn't need to see Donald Trump's income taxes for him to be our president and run our country and make money choices for our country. But they have to put it at the footnotes for a business. Guys, our country is backwards. We care about money so much that they have to include everything. But we do not care about the people enough that we have to know everything about our presidents. Wild, 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 wild. Just my 2 cents. We should know everything about the people that become our presidents. And if they don't want us to know everything about them, maybe they shouldn't be president. So, the information is broken down by level. Got that. Pension plans and other retirement programs. The footnotes discuss the company's pension plans and other retirement or post-employment benefit programs. The notes contain specific information about the assets and costs of these programs and indicate whether and by how much the plans are over or underfunded. And stock options. The notes also contain information about stock options granted to officers and employees, including the method of accounting for stock-based compensation and the effect of the method on reporting results. So, those are all in the footnotes, and we know now to look them up. You can find this isn't the full statement. I was going to say, let's look and see if they had footnotes. What is an MD&A, guys? I have heard this on the news. I have heard this in movies, and I don't know what it means. MDNA, I don't know what that means, but let's figure it out. I know that they make you sign it, though, if you... Actually, I don't know what it is, guys. Let's just read about it. Sorry. You can find a narrative explanation of a company's financial performance in a section of the quarterly or annual report entitled Management's Discussion and Analysis of Financial Condition and Results of Operations. Oh, jeez. I think my fridge is beeping. I thought that was my fridge. It wasn't my fridge. Sometimes I leave my fridge open and then it beep, beep, beep. I mean, it's great because you don't want your stuff to get cold, but like, beep, beep. Anyway, so an MD&A is a management's discussion and analysis of financial condition and results of operation. So the manager is going to discuss and analyze their money and their operations. Got it. So it's a narrative explanation by the manager of the business. It's management's opportunity to provide investors with its view of the financial performance and condition of the company. It's management's opportunity to tell investors what the financial statements show and do not show, as well as important trends and risks that have shaped the past or are reasonably likely to shape the company's future. The SEC rules governing MD&A require disclosure about trends, events, or uncertainties known to management that would have a material impact on reported financial information. The purpose of MD&A is to provide investors with information that the company's management believes to be necessary to an understanding of its financial condition, changes in financial condition, and results of operation. It is intended to help investors to see the company through the eyes of management. It is also intended to help context for the financial statements and information about the company's earnings and cash flows. So this is helpful, guys. If you go and you look at a company's balance sheet, you look at their income statement, you look at their cash flow statement, and you look at their stockholders' equity, and you figure all that out, you can also bop in and read the MD&A from that company and see what the actual management of that company thought about that company or thinks about that company, still the management. So see what he thinks about that company. That's helpful. I mean, not that he couldn't lie, but I mean, that's if he does lie, the SEC, which is the regulatory group, could like bap him. I don't know what they bap him with. Do they throw him in jail? I haven't heard of a lot of traders go to jail. So, I mean, like Bernie Madoff was probably... One day we're going to study people who do this bad and go to jail, like bad guys, because I think that is very interesting to learn about the bad guys of the stock market. So after we know enough about the stock market to understand it, we'll have a bad guy day. And we'll learn about all the bad guys of the stock market, which is probably all of them. I might be a bad guy of the stock market one day. You guys let me know if I become a bad guy of the stock market. So financial statement ratios and calculations. And this is where everybody starts getting scared. Like, I got to do maths. I got to do my maths. No, we can do this, guys. Don't be afraid. You've probably heard people banter around phrases like PE ratio, current ratio, or operating margin. But what do these terms mean, and why don't they show up on financial statements? Listed below are just some of the many ratios that investors calculate from information on financial statements and then use to evaluate a company. As a general rule, desirable ratios vary by industry. And you guys, this is complicated, I know, but you have to think of it in simple terms. If you think of a ratio, like a 2-to-1 ratio just means 2 of something and 1 of something else, right? So a PE ratio means P to E. That's it. This little line means 2. So if a ratio was 2-to-1, that means for every 2 dogs, there's 1 cat, right? And if you wanted to buy a stock with a lot of dogs, you'd probably want a 2-to-1 stock with 2 dogs and only 1 cat. If you wanted a cat heavy stock, you would probably want a 1-to-2 ratio of dogs to cats, where the cats were 2 and the dogs were 1. It's simple, guys. We overthink math problems as soon as they bop in, but this is going to be easy. Just stick this out with me, and we will eventually explain it in a way that one day it's just going to click in your brain, and you're going to be like, oh my gosh, I totally know everything that she just said. Don't worry. It's coming. I promise. You sit here and you listen to my little banter, and if you really listen and you really want to learn, it's just going to pop into your head. We're going to talk about it every day until it does. So, as a general rule, they like debt to equity ratio, which is total liabilities. So that's everything they owe to shareholders' equity. If a company has a debt to equity ratio of 2-to-1, it means the company has $2 of debt for every $1 shareholders invest in the company. In other words, the company is taking on debt at twice the rate that its owners are investing in the company. You see that, guys? You see how easy that was? A 2-to-1. It means their liabilities are 2. The equity that you would get if you bought that is 1. You might not want to invest in there. Inventory turnover ratio is the cost of sales to the average inventory for the period. If a company has an inventory turnover ratio of 2-to-1, it means that the company's inventory turned over twice in the reporting period, and that is great. If you can turn over your inventory, that is win, 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 win. Geez, some people have their inventory for over a year, never turn it over, and lose money. So that would probably be a good company to keep looking at. Operating margin, income from operations to net revenue. Operating margin is usually expressed as a percent. It shows for each dollar of sales what percent was profit. Okay? So that's good to know what was profit. So like if let's say you make lemonade, right? And each glass of lemonade, because you mix them up by the glass, you don't mix up a jar. I don't know why you don't mix up a jar, but you decide to make your lemonade by the glass so that it's fresh. And the ice that you put in the lemonade and the water that you put in the lemonade and the little powder that you put in each glass of lemonade cost you 25 cents, right? That includes the glass. You're going to let them have the cup. It's a plastic cup, and you're going to give it to them. And all of that costs you 25 cents each. But you sell the glass of lemonade for $1. That means that your profit was 75 cents or 75%. So if your profit for each dollar was 75%, that's a pretty good profit. If it was 1 cent, if you were paying 99 cents for each cup and only making $1, then your operating margin, the income from operations, you'd only make a penny per to the net revenues, wouldn't be very good. So then PE ratio. This is price per share to earnings per share. If a company's stock is selling at $20 per share and the company is earning $2 per share, then the company's PE ratio is 10-to-1. The company's stock is selling 10 times its earnings. So working capital equals current assets minus current liabilities. So everything you have right now minus everything you own is your working capital. Makes sense. That's what you have for the week, right? Everything that you have in your pocket minus everything you owe that week is what you have to work with that week. That's easy. So debt to equity ratio compares a company's total debt to shareholders' equity. Both of these numbers can be found on a company's balance sheet. And we know balance sheets, guys, they're assets equals liabilities, shareholders' equity. Okay? To calculate debt to equity ratio, you divide a company's total liabilities by its shareholder equity. Or inventory turnover ratio compares a company's cost of sales on its income statement with its average inventory balance for the period. To calculate the average inventory balance for the period, look at the inventory numbers listed on the balance sheet. Take the balance listed for the... This is why you have to know these, how to read these. You have to know when you look at a balance sheet, you have to be able to calculate the average inventory balance, right? And in order to do that, you have to take the balance listed for the period of the report and add it to the balance listed for the previous comparable period and then divide by 2. Remember, see how easy that is? Like all you have to do is add 1 plus 1 and divide it by 2. 1 plus 1 and divide it by 2. It's not hard math, guys. I promise. It's just we have to use these sheets in order to do these things to figure out if a company is profitable or if it is a good investment. So, not a lot of math, guys, just a lot of paying attention. And that's okay because, like I said, this is not going to be 5 classes and you are out trading stock on the stock market. That's not how this is going to go. We are going to learn for a long time. And that's okay because we're going to have fun while we're learning. And we are going to go over everything a whole bunch. I know I say that a bunch, guys, but look at these words. Inventory turnover ratio. Just seen that. If somebody clicks in right now and they see inventory turnover ratio compares a company's cost of sales, they are going to be like, no, I can't learn this. This is way too much. And she's reading way too fast. But guess what, guys? This is just an SEC's overall report and publication. This is not where we are learning. This is basic just to hear the words. Remember what I told you guys. In order to learn something, you need to hear it, see it, and work on it multiple times, and that is okay. When we send our children to school and they have to learn math, they have to learn reading, their teachers do it over and over and over with them again. So my thought is just like elementary school, you log in and we talk about this every single day. And before you know it, it'll take an hour out of your morning. Maybe you can't watch it in the morning. Maybe you log in and watch me at night. And you listen until you hear enough that you're ready to start Googling it. And once you start Googling it, guys, once you're interested enough to really get going, you're going to get into Investopedia and you're going to, instead of just reading what I show you, you're going to want to read every single one of these in the table of contents. You're going to want to read every single thing here. Trust me. So we will understand this. Don't give up. We're almost done today. We're going to finish this out. I have a couple things I want to show you. It's not homework, but you will like it. So stay tuned. We're going to get to that as soon as we're done with this. We're almost done, guys. This was a long one. And that's okay. Some days are going to be long and kind of boring. But once we get through this, you will understand it better. So inventory turnover ratio compares a company's cost of sales on its income statement with its average inventory balance for the period. To calculate the average inventory balance for the period, look at the inventory numbers listed on the balance sheet. We're going to do practice ones of these, guys. I am going to go through them with you. We are going to practice inventory turnover ratio. Take the balance listed for the period of the report and add it to the balance listed for the previous comparable period. And all we need for that is 2 periods, right, of reports, and then divide by 2. So remember that balance sheets are snapshots in time. So the inventory balance from the previous period is the beginning balance for the current period, and the inventory balance for the current period is the ending balance. To calculate the inventory turnover ratio, you divide a company's cost of sales, just below the net revenue on the income statement, by the average inventory for the period. Or there's operating margin. Compares a company's operating income to net revenues. Both of these numbers can be found on a company's income statement. To calculate operating margin, you divide a company's income from operations, before interest and income tax expenses, by its net revenues. Or PE ratio, and we know that one from up above, compares a company's common stock price with its earnings per share. To calculate a company's P&E, you divide a company's stock price by its earnings per share. Working capital is the money left over if a company paid its current liabilities. So that is, working capital is your current capital, or your current assets minus current liabilities gives you working capital. Bringing it all together, finally. Although this brochure discusses each financial statement separately, keep in mind that they are all related. And we see that here, guys. This is how they're finding out all of these useful, what do they call these? Financial ratios and calculations. All of these ratios and calculations, guys, all of them can be found on these 4 statements with just a little bit of math. So we're going to practice those and bring it all back to this another day. This is the first, guys, this is day 4. Like I said, just breathe. We are going to get through this, and it's going to be great. So the changes in assets and liabilities that you see on the balance sheet are also reflected in the revenues and expenses that you see on the income statement, which result in the company's gains or losses. Cash flows provide more information about cash assets listed on a balance sheet and are related but not equivalent to net income shown on the income statement, and so on. So for instance, income statement, bottom line, they put, oh, these are different companies. I was going to compare them. Cash, no one financial statement tells the complete story, but combined, they provide very powerful information for investors. And information is the investor's best tool when it comes to investing wisely. Alrighty, guys. That was very good. So, like I said, SEC, guys, you go into the sec.gov. They have investors' reports and publications, and there is a ton. We can do info sheets. They have tools and calculators. What do they have? A fund analyzer, Social Security retirement estimator, college savings calculator. They have a lot of great stuff, but one of the really great things that I wanted to show you guys, if you waited this long, congratulations, you are the best, and you will be a stock pro soon. Well, not soon, but one day, guys. We're working on it. So I found this, and it's on the SEC. It's called Saving and Investing. It's a PDF, and you can download it, guys. It is here. Here on the SEC. Just go here and search. Search Saving and Investing. Like this. Saving and Investing. Well, if I can write, Let's see if it searches it. So go there. Saving and Investing PDF. I don't know, guys. I don't remember how I found it. Well, you know, I guess, look at it right there, guys. Go do this. sec.gov investor publications, SEC Guide to Savings and Investing. Just go there. And it is very long. It's 32 pages. We're not going to go through it together. I want you to, if you want to go through it, I want you to go through it on your own. I will be reading it tonight. This is just a basic guide to saving and investing, guys. If you have no knowledge on saving and investing, come here. If you need to save for a home, a car, an education, your children, medical, caring for parents, you come here. They have you an area where you can write your financial goals. They have an area where you can set up your net worth statement. this is how the very first step to becoming a trader is getting your financials under control. Right, guys? You have to understand your finances in order to be able to trade. So this is my biggest advice to everybody, guys. Pay yourself or your family first. Include a category for savings and investing. Pay yourself every month. I understand you have bills, but guess what? That bill is always going to be there, people. And guess what? You're not going to go to jail. This is not back in King James time. You are not going to go to jail for not paying your bill. Well, I mean, if it's a tax bill and it's really high, you might. But like, we're talking about, for instance, let's say, what's a bill? A light bill? You can go ahead and save. Apply for help. You guys, we have to get out of this idea that everybody gets paid before us. We think, oh, well, I have to pay my credit card bill because if I don't pay my credit card bill, they're going to come after me. Well, if you can't pay your credit card bill, but you can only pay yourself, don't hate yourself. You deserve the money. You go to work. You work hard. Why work if you can't pay yourself? Why take time away from your family if you can't pay yourself? So that's where I'm at, and that's where they're at, and that is what you need to be. When you can get there, you will be able to invest money. We have to stop thinking about money as everything in life. And I know that's really hard, guys, because sometimes money is the only thing you have in life keeping you alive. And I understand that. So finding money, they have this, and it really helps. It's so that you can think about every single thing you're spending on, because I promise you're spending on things you shouldn't be. Even if you think you're not, you are. Are you spending too much money on the type of clothes you're wearing? Are you spending too much money on the coffees you're drinking? Are you spending too much money on a game habit? Are you spending too much money on your internet? Is there a way that you can do internet for free? Do you have neighbors that have internet? Do you have an area where there's free internet? I know in Washington, we have a lot of cities that offer free internet, free Wi-Fi. McDonald's offers free Wi-Fi. I know that my Wi-Fi is my internet is one of my biggest bills. It is big, and that is because I have fast internet in order to stream to you all, and it costs a lot. So if I needed to find money to save or invest, I could cut my internet out. What can you cut out? And this is helpful for that. So it helps with small savings add up to big money. It gives you a lot of paying off credit cards with high debts. Making money grow. What are the 2 ways to make money grow? Basically, 2 ways to make money grow, guys. Money, you work for your money, and that's what the majority of us do. We work for our money, right? Someone pays you to work for them, or you have your own business. You work for the money. You do hair, you do nails, you do painting. I don't know. You just go to a job every single day. You go to Amazon and you check in and you do work, right? And you make money. The other way to make money is your money works for you. You take your money and you save it or invest it, and it starts making money for you. You know how? With interest, guys. In the stock market, when you make a smart investment, you gain money. You're making your money work for you rather than you working. The only work you had to do was throw that money in the account. Let's say you save it. Let's say you do not want to invest, but you want to save in a high yield account. You save that money and you throw it in there, and now that money is working for you. You're not working for that money. The money is sitting there, earning interest, working for you. 2 ways to work, guys. I prefer this way. Just me. Some people love to work for money, and that's okay. Shoot. I prefer this way. And that is why I'm here learning this, because even when I work for money, guys, everybody has to work for money, right? Like, I'm here talking to you guys, working for money. People at the grocery store working for money. People at hospitals working for money. We're talking lawyers working for money. It's okay. There's no shame. A judge is working for money. A lawyer, a cop, a doctor, all of those people are working for money. Someone pays them, or they have their own business. A landscaper that owns his own business, he goes out and works for that money. Even if he doesn't mow the lawns, let's say he has 5 guys mow the lawn. He's still working for money. He has to employ those people. He has to do the taxes. That money is not working for him. But if he takes some of his landscaping money and he puts it into the stock market, now he's working 2 different ways. He's working for his money, and he's having his money work for him. And this, you need to be here in step 2. In 2023, guys, this is not an option anymore. It was an option when I was a child. You could live your whole life and just work for money and live the American dream. You can't anymore. You have to have your money working for you. So, your money earns money. When your money goes to work, it may earn a steady paycheck. Someone pays you to use your money. When you get your money back, you get it with interest. Or you buy something with your money that can increase in value, like a stock or art. Art is really, really big with increases in value. So you buy some art and then it bops up and you become the owner of something that's more expensive and your money made money. So this is a helpful, we got some basic types of products, things that you can invest in, savings accounts. We're going to talk about every single one of these here. So by having this and reading it, you will have a jump on us. I'm going to read it tonight. So that, guys, the difference between stocks and bonds, we learned this on the very first day, guys. So this will help you review what is an EFT? Mutual funds, EFTs. We learned about that the second day. So this is a review of what we've learned with new items and helpful things for you. Let me see if there's anything else. Helpful contacts. There's a lot of stuff here, guys, that is, I know a lot of it's just like blick, 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 but there is so much here that is going to help you if you are at the beginning of your journey. I would say download it. It can't help it. Just give it a read. If you don't want to read it, I'll stick around. I'm going to talk about it anyway, but maybe you want these, what were these called? These little, so that you can fill these out. Like, what do I want to save and when? For me, my financial goals, guys, I will give you my first financial goal. My first financial goal is to be able to have an actual account for online trading. So I'm not sure, guys, if I'm going to use the foreign stocks. I can't talk. The foreign stock exchange, or if I'm going to use the New York Stock Exchange. I'm not exactly sure what we're going to do. Are we going to be trading options? Are we going to do stock? Are we going to do day trading? I'm not quite sure yet. We still have more learning to do. Oh, I got a crick in my back. We sat here for so long. A good hour of learning today, guys. But I want to be able to save up enough money to set up a stock market account and really get to learning to trade. In order to do that, we have to learn all these basics. Well, I have to learn all these basics. I'm not just going to open up an account and start throwing money at the stock market. I have read all of the bad horror stories of that, and I am not going to do that. What I am going to do is learn everything I can learn. And this week, at the end of the week, we are going to begin opening our, well, I already opened my Thinker Trade, guys. I have a TD Ameritrade account where I can paper trade and practice, and that is where we're headed. So if you do not have one, perhaps you can bop over to either Webull. It's Webull. I don't know how to use that one. I am using TD Ameritrade, guys. It's called Think or Swim. Let me show you. Okay, let me see. So this is them, TD Ameritrade, and we want to do Think or Swim, and this is their program, and it is like this. It's free. I know it has pricing, guys. So we can do paper trading, investment product tools and platforms. What do they have? Think or Swim desktop, Think or Swim web platforms, and mobile trading. And this is the actual trading platform that you can trade stocks on. You can do this with money, but you can also do it, like I said, with paper trading. And paper trading will just let you practice. I can't pull it up right here, guys. Just have to log in and all of that. So I will show you mine when we get to that, but I just wanted to give you a chance to go ahead and open it up if you want. Open up a new account. You do not need any type of bank account information. I opened mine up. I do not have a bank account link to it. So you can do that and get it going. All you have to do is put in your information, and then when you come and chill with me during the live, I will show you how to set it up and we will learn about it together. It won't be a big deal. And that is it for today, my friends. I have went through everything I wanted to go through. We talked about this, where you can get it. Here is the sec.gov/investor/pubs/sec-2-savings-n-investing.pdf. Perfect. And then that's it. I can't think of anything else, guys, that I haven't said. So I am going to wrap this up. We have about an hour of learning today. This is day 4. I will be back tomorrow, same time, same place, hopefully with my mic turned on. Like I said, if you bop into the chat and you do not hear me, please throw it in the chat to turn on, Squealer, turn on your mic. Because I don't like to record with no sound and then have to delete the entire thing and say it all over again. So here we are, and another day in the books, guys. I am not going to give any homework other than why don't you check this out? Savings and investing, a roadmap to your financial security through saving and investing. Beautiful. So I hope you all have a wonderful day. It's great to start your day off with learning. And I hope that I see you next time. What else? What am I supposed to say at the end of these? Like, share this with somebody who needs to learn, and subscribe so that they will give you notifications when I go live. I am live pretty much every day, doing different things. We got some gaming going on this channel, and I hope that you find something you like. And if not, you know what? Throw it in the comments and tell me what you do like. That's it for today, guys. I will see you later. I will be back tonight on Hogwarts Legacy for sure. I am in love with that game, but I took a little bit of time off because honestly, I don't want it to end, guys. I like the game so much that I want to keep it forever. But I know that that's not possible, so press on we must, and I will be pressing on this evening, very late, on live, Hogwarts Legacy. Be there or be square. And if you can't catch it or you just don't like gaming, bleh, I say bleh to that, but it's okay. Just come on back tomorrow morning into the wonderful world of finance and check us out here so you can learn about finance. I mean, gaming, finance, we're all over the place here, guys, and that's okay to be. I like it. It's good. I'll see you guys around. And bring your friends. Who doesn't deserve to learn about money? Everybody, right? We all deserve to know about money. So I will see you neighbors later. Have a beautiful day and enjoy yourselves.